Hey everybody, welcome back to the channel. Today I want to talk about L3Harris Technologies, ticker symbol LHX. The stock is down about 15% year to date. It is down almost 25% over the past year. So I think this is a good time to jump in and take a look at this company, figure out what the stock is worth and if it's worth buying into at this time. There are a couple reasons why the stock has taken a fall over this past year. One reason is that margin compression has occurred with the company on the gross margin and operating margin line of the P&L. Another aspect of why the stock has fallen is a couple of acquisitions or mergers that L3Harris has initiated over the past year. On one hand, they bought tactical data links from Viasat for about $2 billion, and they also are merging with Aerojet Rocketdyne, ticker symbol ARJD, for about $4.7 billion. Now, keep in mind, both of these acquisitions or mergers will be funded by debt. These are not small acquisition or mergers by any means. This company is worth about $35 billion, and combined, the company is spending almost $7 billion on these two acquisitions. Now, the Aerojet specifically looks pretty interesting and doesn't look like a bad deal. In fact, here's kind of a snapshot of what Aerojet Rocketdyne will be bringing to L3Harris. So they did about $2.5 billion in revenue. They have about $6.7 billion in backlog. They have about 5,000 employees, 1,500 engineers. Their EBIT or operating margins are about 12%, and their EBITDA margins are about 14%. Similar to L3Harris, Aerojet Rocketdyne is also a government contractor focusing on space and defense. Defense is their major segment of their business, but space takes up about 33%. Now let's focus a little bit more on L3Harris Technologies itself. Like I said earlier, they did about $17 billion in revenue in the past year. Their operating margins were about 15%. Now this is on a non-GAAP basis. Their adjusted EBIT or operating income is about $3.2 billion, and then adjusted free cash flow is roughly about $2 billion. What's interesting is their diversified business mix. My personal background is in government contracting, so this is very familiar to me. So for example, out of 100% of their revenue, 35% is on the subcontracting side, 65% is on the prime side. So prime is a contract that you won directly from the government, or if it's a subcontractor, that means you're a sub of a prime. So there's another company that won that project, asked for you to work on their prime contract as a subcontractor. About 75% of their contracts are fixed price, about 25% are cost plus. So fixed price means the contract is set in stones for its exact amount, say $10 million, and it's milestone based. So once you hit a milestone, then you can bill for that milestone, etc. The great thing about those, if you're very efficient and you bid on them very well and you come under budget, you can make a lot of money. On the flip side, if you're not efficient and you spend more than you anticipated, you can end up on the wrong side and have really bad margins or no margins at all. Where cost plus, you actually get to bill the government exactly your costs. And the reason why it's called cost plus is the plus is award fees or cost underrun fees, some kind of fees on top of that cost. So that way you can make a little profit on that contract. L3Harris, 60% of their revenue is from Department of Defense, 20% is international, and then other is 20%. The company currently employs 46,000 employees. The company operates across 3 reportable segments with a strong focus on military communication systems, which can be broadly clustered as command, control computers, communications, cyber, intelligence, surveillance, and reconnaissance. The company also has a sizable exposure to space tech, which is to be further strengthened by the pending Aerojet Rocketdyne acquisition. Something else I should note is that L3 and Harris actually merged together back in 2020 to become L3Harris that we know today. Next up, let's take a look at their financials. Typically, I like to go back 10 years. Unfortunately, since this company merged back in 2020, we can't go back that far, so we can only see the last 3 years. So here we go. So in 2021, the company had an enterprise value of $51 billion. Today, it's at $43 billion. The market cap is almost $35 billion. During that time frame, sales per share has grown only 2%, going from $88 to $95. During that same time frame, EPS has shrank going from $5 to $4, which is a negative 7% decline. Free cash flow per share very similar, declining from about $11 down to $9, which is a negative 6% decline. Book value per share has also declined about 1% from $101 down to $97. Return on invested capital has not been very good, averaging around 5% during that time as well. Now, their EBIT to net debt ratio looks pretty good at being a 0.2 right now. Their debt to equity at 51% also looks really good at this time. Their current ratio is at 1. So all that with the balance sheet looks pretty solid. Now, the market multiple on average over the last few years has been a 25. Now, government contractors in general tend to trade at a higher premium than the rest of the market. For example, RTX is usually in the 20s. Lockheed Martin also carries a pretty high premium as well. That is not surprising since most of the revenue that these companies generate comes from the government, and for the most part, it's pretty much guaranteed money. Defensive contractors like L3Harris also tend to give a lot of money back to the shareholders, whether it's buying back shares or having a nice dividend. Currently, right now, L3Harris carries about a 2.5% yield for their dividend. Now, gross margins have gone down a little bit from about 30% down to 27%. That's an average of 29% over the last few years. Operating margins have also declined during that time, going from 12% down to 10%. Another reason why that the stock price has fallen this year. So we have margins compress, and then you also have two fairly large acquisitions that you make. It does put pressure on the market, and investors sometimes don't know where the company is going, or especially when fundamentals are deteriorating, which has caused concern overall. Next, let's take a look at what analysts think this company is going to do over the next several years. So sales, I think, is going to grow up around 8% per year. So in 2022, they were around $17 billion in revenue. They think that's going to grow to about $25 billion in revenue in 2027. Operating income, they think, is going to grow around 7%, going from $2.6 billion in 2022 to $3.6 billion in 2027. Net income is also supposed to grow around 7%, going from $2.5 billion to $3.5 billion in 2027. Free cash flow is supposed to grow at 10%, so double digits, going from $2 billion to $3.2 billion in 2027. I should also note that cash from operations is supposed to grow 12% per year, and EPS is supposed to grow at a 23% clip per year. So let's take a look at our first valuation template, and this is the margin of safety calculator. Essentially what I'm doing here is trying to figure out what the normalized EPS for the company is, which I think is at $8.50. From the research I've done and what I'm projecting for this company, I think from an EPS of $8.50, I think it's going to grow around 15% per year over the next several years. Based on the information, I come with a target buy price of roughly $170 as of today, and the current stock price is around $178. Next valuation template I want to take a look at is my discounted operating earnings model. Essentially what I'm doing here is trying to calculate operating earnings out over the next several years, discount it back today to try to figure out what the intrinsic value of the stock is. In order to do that, I first need to calculate what I think sales is going to grow. So I think it's going to grow about to $18 billion this year. It's a 5% growth. Management has guided between 5 and 6% this year. I think it's going to grow 8% the following year, 10% the following year, then 9%, then 9%, which comes out to about $25 billion, which is very, very similar to what analysts think the company's going to do over that same time frame. I also think operating margins are going to go down this year, going from 11% down to 10%. I do think they're going to start recovering a little bit and building up to about 12% about 5 years out from now. I'm also assuming that operating earnings is going to grow about 10% based on this information. I'm also assuming that an exit multiple for this company will be around a 24. Again, the market has been willing to pay higher multiples for government contractors, so I think that is a reasonable multiple for this company. Based on this information, I think the stock price 5 years from now should be around $388, which gives me an intrinsic value of $193 here today. Next valuation I want to take a look at is the 10 cap valuation. This valuation looks at owner's earnings of a company, and essentially we don't want to purchase the company for more than 10 times the operating earnings. So in order to find this out, we try to figure out what a normalized free cash flow for this business is. I think it's around $2.2 billion. I also think their tax provision normalized is around $200 million. Based on this information, I get a 10 cap valuation of $127. The last valuation template we're going to take a look at is a payback time calculator. I basically want to put money into a company and get my money back within 8 years. So why do I want a return of 8 years? Well, that is half of what the market has been willing to pay for companies across all industries over the last several decades. So if I can try to get my money back within 8 years, that means there probably is a pretty good margin of safety that I'm buying into the stock at this time. Currently, I have a payback time of 9 years, so it does not look like a good buy according to this model. So let's take a look at the valuation summary of all 4 models that we looked at. So first, the discounted earnings model, I came up with a fair value of $193. A 30% margin of safety would indicate a good buy price for me, which would be $135. The payback time model suggests to buy at $160. 10 cap model suggests at $127. The margin of safety calculator suggests buying it at $171. Again, today's stock price when I'm recording this video is $178. Next, let's take a look at the return on investment I would expect to get from this stock based on different stock prices. So if you're watching this video and the stock price is $156, I would expect a 15% return on investment for this stock. Today, the stock is trading around $178, so I think I would get roughly 11% return on investment based on today's stock price. Now, that is assuming a sales CAGR growth of around 8% per year over the next several years, EBIT growth or operating income growth of around 10%, and then a market multiple of 24. Now, keep in mind, the company is paying a decent dividend at this time, $7.91 annualized for one share. That is 2.5% yield. The company has indicated that they do want to put a lot of money back in the shareholders' hands. We'll have to see long term, as this company is fairly new, how it's structured right now. And with the merger of Aerojet Rocketdyne, it should make it very interesting moving forward, especially with their backlog should be growing anywhere from $25 to $30 billion with that acquisition. Thanks for hanging with me all the way through this video. Again, this was L3Harris. Hope you enjoyed the video. If you got some value out of it, go ahead and hit the like button. If you like this kind of content, I encourage you to subscribe to my channel. Hit that bell notification as well. If you want to know how to value companies, I do offer valuation templates on my Patreon. I'll put a link down below in the description if you want to go check that out. You also get access to my Discord channel as well. If there's a stock that you'd like me to analyze, throw it down in the comment section. I read every single one of those. Thanks again for watching. I'll catch you on the other side. Take care and God bless.